السلام عليكم ورحمة الله وبركاته. طلاب سنة أولى العبور. Now we are approaching the subject of accounting for partnerships. Actually, in this first lecture of online learning of this subject, we decided to cover all what we have done orally in Abur college or in Abur site. For example, here we have in the introduction, what is a partnership? We are defining a partnership. It is an association of two or more persons to carry out or to carry on as co-owners of a business, of course, with the purpose of making profits. If the purpose is not profit, then it is not a partnership. It could be a charity, a cooperative society, or whatever other kind of business or other kind of of an institution. Then we have here the characteristics. What are the characteristics of a partnership? This is just a reminder to you. Number one, the first characteristic, it is an association of individuals, not an association of legal persons, not an association of companies. There is also another characteristic, which is mutual agency, where each partner is acting on behalf of the others engaged in the partnership. And every partner is working on behalf of the whole group. This is mutual agency. Everyone is an agent for the benefit of the others. Limited life. Yes, the life of the companies, usually companies have long lives. But partnerships, they don't have long lives, simply because individuals don't have long lives. And so the life is limited. But the responsibility toward the debts, the debts of others, the liabilities of others, this liability is unlimited. And this is really a drawback in partnerships. Then we have also something which is co-ownership of property. The properties of the partnership, they are owned collectively by all partners. No partner can claim and say that this kind of asset is mine and the others are not. Or this is mine and the other partners have no right. It is me only who has the right. Oh yes, this is very important. Then we have here organizations with partnership characteristics. There are organizations which have similar characteristics, but not the same. Here we have what we call as limited partners, or we call them as partners whose liability for the debts of the firm is limited to their investment in the firm. Limited partners. شركاء الموصين. General partners whose responsibility is unlimited. Limited liability partnerships. What is meant by limited liability partnerships? These are partnerships which are actually prevailing among professionals, like accountants. All the accounting firms outside Egypt, they are taking the form of limited liability partnerships. They are partners, but all of them have limited liability toward the debts of others. They cannot. No one partner can pay for the debts of the partnership on behalf of the other partners. Limited liability partnerships. Then we have what we call as limited partnerships. شركات التوصيل. in which we have limited partners as well as general partners, where the general have unlimited liability, while as the limited partners have limited liability. This is a mix of limited liability partners and unlimited liability partners, which is very interesting. Then we have what we call as unlimited partnerships. Of course, the unlimited partnerships are what we are calling as general partnerships, where all partners have unlimited liability toward the debts of the partnerships. They will be held responsible for the debts of the partnership in case it was bankrupt, in case it was liquidated. Then there is, very important for us from the legal point of view, there must be a partnership agreement or a partnership charter, and this charter should at least, as a minimum, should have or should include these data or these information. Number one, we have the names and the capital contributions of each partner. Who are the partners one by one, and what is the share of capital of everyone? The rights and the duties of partners. Who will be managing and who will not be managing? Who will be managing for a salary and who will not be managing and will not receive a salary? Then here we have basis for sharing net income or net loss. There must be a basis, there must be a rule on how to share net income or net loss. And this should be mentioned in the contract, in the agreement in advance. It has to be mentioned so that when there is an income or there is a loss, the partners will not, go into dispute. To avoid disputes, these matters have to be clearly stated in the contract. Provisions for withdrawals of assets. What are the conditions for withdrawing assets from the partnership? Withdrawing of goods, withdrawing of cars, withdrawing of, maybe PCs or furniture or whatever. There must be a condition, or there must be clear, rule on how to withdraw. Who will have the right to withdraw assets and who will not have the right? And if someone has the right, what are the conditions for recording this withdrawal? How is he going to be accounted for? How these withdrawals shall be accounted for? Then procedures for submitting disputes or arbitration. Yes, sometimes it may happen that there could be a disagreement may arise between partners, maybe two or more partners at the same time. And the question is, what are the procedures to go to arbitration, to go to a court? There must be a clear indication of the rule of sorting out, or I would say solving disputes or referring disputes to arbitration. Then procedures for the withdrawal or addition of partners. Yes, what are the conditions for admitting new partners? And after it has been established, after it has been already existing and already expanding, what are the conditions for accepting an offer by someone else to become a partner? What are the conditions for accepting this new partner, this newcomer? Or if someone of the existing partners decided to withdraw, to retire, to leave the partnership, what are the conditions? And how are we going to give him back his right in the company? How are you going to calculate how much is his right or his capital in the partnership, so that he will receive this and goes back to his own affairs or to his own life? Then here we have an example on the Formation of the partnership. Here, formation could be in cash. It may be in cash that more than one partner are paying in cash. I may say, for example, Mr. A shall pay 10,000 pounds in cash, Mr. B shall pay 20 pounds in cash. Maybe Mr. C shall present sundry assets, more than one asset. So in this case, we shall say cash to partner A capital, 10,000. For B, we say cash debit and partner B capital for 20,000. Then for again, this entry is repeated actually. Then for partner C, we may say, here we have maybe a cash account, not cash account, but I say here, for partner A it is finished. This second, when we say second sundry assets, I mean that a partner is paying more than one asset, like C. He is going to present furniture and inventory. Furniture of 15 and inventory of 5 with a total of 20. But it is written here partner B. It should be C actually to make it, to make the comparison useful, because we have already A and B, they paid in cash. But here assume that number A paid in cash and B paid in sundry assets. It doesn't matter. But anyway, if there are sundry assets presented by a partner, then we debit these assets and credit his capital account. Then we come to another story, an important accounting story. What will happen if a proprietor presents the assets and liabilities of his business to become a partner in the partnership? And here we have two bases. The first basis or the first case is revaluation of assets and liabilities of this proprietor. The second case, which is no revaluation of the assets and liabilities of the new or the proprietor. In the first case, remember these points. Here we have revaluation of assets and liabilities. Then the partner has to pay for the shortage of net assets. He has to pay for the shortage in cash. It may happen also the opposite way around. Revaluation of assets and liabilities, then the partner shall receive the excess of net assets in cash. He might have presented net assets which exceed his share in capital as mentioned in the agreement. His share is 20,000, but he presented net assets of say 25. So he has the right to receive the additional 5 or the excess 5,000. He has to restore this. He has to be refunded back this 5,000. NB cash balances are excluded from the valuation. What does that mean? It means that don't evaluate cash accounts. Don't evaluate bank account, except if the cash or bank is in foreign currency. If it is in foreign currency, then you have to reevaluate. You may say, this is an amount of dollars or euros or yens or whatever other foreign currency, and they were bought in the past for this price. And now the price is different. It is either the same or more or less. So depending on this exchange, if there is cash, then cash has to be reevaluated if there is a foreign cash. But if it is not a foreign cash, then there is no revaluation of the local cash. The Egyptian pounds, for example, are not going to be reevaluated. Of course, this is in accordance with an assumption in accounting. We assume the stability of the currency, the stability of the value of the currency that was used in recording the accounting transactions in the books. In the second case, there is no revaluation of assets and liabilities. They shall be taken according to their book values or book balances of the sole traders. And again, cash balances are also excluded from revaluation, except if they were in foreign currencies. If there is a shortage in the net assets of the proprietor or the sole trader, this difference, which should be debit, but here he shall not pay cash, but this difference shall be called goodwill. In the opposite case, if the net assets are exceeding the agreed upon share of capital as mentioned in the contract, in the partnership contract, then this difference in the credit side is named or called the capital reserve. So we shall either have cash account debit or credit if there is a revaluation, or you may have goodwill as debit and capital reserve as credit in case of that there is no revaluation. Here we have an example on the revaluation. Assume that Mr. A and Mr. B are sole traders who agreed to form a general partnership named Hope. Mr. A capital will be 12,000 and Mr. B capital will be 14,000, and they agreed to revaluate their respective assets and liabilities and to adjust for any differences in cash. Mr. A business or balance sheet at the beginning of January 2019, there was furniture of 6,000, there was accumulated depreciation of furniture 1,000, and the net amount is 5. Then we have inventory 4,500, we have accounts receivable, and we have cash. On the other side, we have capital as 12,500, we have accounts payable as 1,000, we have bank overdraft as 1,500. The two sides of the balance sheet are equal. Then now we can go ahead and say the results of the revaluation. What were these results of revaluation? What has happened as a result of the revaluation? We have accumulated depreciation has to be increased by 1,000. It is already 1,000. Then we shall increase it by another 1, so the total shall be 2,000. And therefore, net furniture will be 4,000. The market value of inventory is 4,100. It is in the balance sheet 4,500. Now the expert said it is 4,100, and therefore we have to accept it and we record it as 4,100 only. Then again, there is an unrecorded interest expense on bank overdraft 100. There is a bank overdraft as a liability, and there is an interest of 100, and this interest has not been recorded yet. And so we come to the firm of Mr. B. We have furniture as 3,500 and accumulated depreciation as 500. We have inventory as 9. We have securities as 2. We have accounts receivable 2,500, and we have allowance for uncollectible accounts receivable as 500. So the net is 2. Then we have bank current account 1,000 and the cash account 500. Then on the other side of the balance sheet, we have capital as 15. We have accounts payable 2 and accrued rent 500. The results of revaluation were as follows. Accumulated depreciation for furniture has to be increased by 500. It is already 500, so we shall increase it by another 5, so it shall become 1,000. 1,000 deducted from 3,500, then the net amount will be 2,500. Remember this. The market value of securities is 1,800. It is here mentioned as 2,000. Therefore, we shall accept it and we shall take it as 1,800, not as 2,000. The allowance for uncollectible AR has to be increased by 100. Yes, there is an allowance for accounts receivable, uncollectible accounts receivable. It is 500. Then this has to be increased by 100. So it shall become 600. 600 out of 250, it will give 1,900. That is all regarding the revaluations. Then Mr. C has paid 15,000 in cash. There is a partner who is Mr. C. He has no business. He is not a proprietor, and he shall pay 15,000 in cash. Required record the above events in the books of the whole partnership, withdraw up the profit and loss revaluation account, and settle any difference in cash. Any difference, whether it is credit or debit, this has to be settled in cash. Then if we record the assets and the liabilities of every one of them, then we shall say for Mr. A, we have furniture 60,000, we have inventory 4,100, accounts receivable 3,500, and the cash the same 2,000. On the other side, you have accumulated depreciation, it has become 2,000. Accounts payable the same, bank overdraft the same, but there is a liability, a new liability, which is unpaid interest expense 100. All these are credit, you add up them, you subtract from the total debits, then you shall come to capital, and I wrote here that it is concluded. So capital account here concluded, yani we calculated, we concluded how much is the capital of this trader. It is after revaluation, it equals 11,000. But we need him to have a capital in the partnership as 12,000. And therefore, he has to pay for the difference. He has to pay in cash. So that is why we are debiting in entry 1B, we are debiting a cash account and crediting A's capital account. And here notice that the capital of Mr. A, according to his assets and liabilities or net assets, is 11,000, which is less than the agreed upon capital, which is 15,000, which is 12,000, as the difference should be settled in cash. Mr. A should pay 1,000. That is why we shall have here furniture at the new value, inventory at the new value. This is for Mr. B, I'm sorry, Mr. B. Securities a new value, accounts receivable, bank current account, cash account, then we have accumulated depreciation, the new amount, allowance, the new amount as well, accounts payable the same, accrued rent the same, then we have capital account concluded as for 14,200, and therefore here there is an addition, or there is an excess of the capital concluded account balance and the capital agreed upon in the partnership contract. The partnership contract agreed upon capital is for 14,000, therefore Mr. B shall restore or shall be refunded back the difference, which is 200 pounds. So we are debiting Mr. B capital and crediting cash account. Of course, you can see the comment I wrote. There is an excess of 200 which is paid back to him. This shall be paid back to him in this way. Of course, recording Mr. C capital by debiting cash account and crediting C capital account for 15,000. Then we have drawing up of ledger, the ledger of cash account. The cash was debited with 2,100, 1,500, 15,000, and debited with 200, and there is a balance of 18,900 pounds. There is a debit balance of cash account. Then if we prepare the balance sheet, then we have the capitals of A and B. They are 12 and 14, and their total, Mr. C, I'm sorry, is 15, and therefore their total is 30, is 51, I think, 51. Wallah. Yes, 41, not 51, 41,000. Then we have accrued rent as a liability. We have unpaid interest expense as 100. We have accounts payable. We added up the accounts payable in the two proprietors' balance sheets, and we have also bank overdraft 1,500. In the balance sheet we have furniture, the total of furniture of the two proprietors plus the total of the accumulated depreciation for the two, the inventory, the total of the two, securities, accounts receivable minus the allowance for accounts receivable for the uncollectible accounts receivable 600, and then we have bank current account for both of them and the cash account for both of them. Then we have the last example where we are assuming the same problem that we have done, and we have compensated for the difference or settled the difference in cash. Now we are going to settle the difference in terms of goodwill and capital reserve account. For the first partner, there is a 12,000 pound his concluded capital, but notice that the capital of A, according to the assets and the liabilities or net assets, is 12,500, which is greater than the agreed upon capital, which is 12,000, and therefore the difference should be settled not in cash. So the difference should not be settled in cash, and should be settled in capital reserve. That is right. There is no difference. There is no problem. It should not be. And here the capital is the addition to capital is debited to capital account and credited to capital reserve account. Yes, regarding Mr. B, these are the assets and these are the liabilities, and his capital has concluded as a result of comparing the book values of assets and the liabilities. His capital appears to be 15,000, while as his capital should be how much? Should be 15,000. This is 15. It should be 16. So the difference should not be settled in cash as well, and should be settled in goodwill. I mean in accounting terms, not in cash terms. That is why goodwill account is debit and the capital account is credited. Then we go to the cash account balance. It is 17,500. If we go to the balance sheet, we shall have the capitals of A, B, and C as agreed upon, 12 plus 16 plus 15. We have accrued rent, we have capital reserve, we have accounts payable, we have bank overdraft account. Then on the other side we have furniture, the total of the two, accumulated, the total of the two, inventory is the same after evaluation, and we added the two for the two. Securities, it was for one of them only. Accounts receivable and its allowance, yes, accounts receivable is 6,000 and the allowance is 500, the net is 5,500. Bank overdraft the same, and the cash account, adding the cash in the two balance sheets, the previous balance sheets. So we have 17,500 plus goodwill 1,000, the goodwill of the last partner. It is now shown as a debit account here. Then if you add up the two sides of the balance sheet, you shall surely find them as equal or as completely correct. Then this is an exercise that you have to try. We have Mr. R and Mr. S. This should be capital S. They are sole traders who agreed to form a partnership named R&S firm. Mr. R capital should be this amount, 22,000, and Mr. S capital should be 15,000. They agreed to present their assets and liabilities except cash without revaluation, and where a shortage should be considered as either goodwill or an increase in capital reserve. Should be considered as and recorded as goodwill, and an asset and an excess is to be considered as capital reserve. That is why we have capital, we have accumulated depreciation cars, accumulated depreciation furniture, allowance for uncollectible, we have 15,000, accounts payable 3,500, accounts payable 4,000. On the asset side, we have motor cars, we have furniture, we have inventory, we have accounts receivable, we have bank current account, you have cash account, and the two sides of the balance sheet are equal. This is another partnership. The first one, it was a balance sheet of appropriator, and this is another balance sheet of another appropriator, and they wish to amalgamate together to make up a partnership. So there is nothing strange in the style of the accounts on the asset side and the liability side. There is no difference between the names here. They are the same. I mean, this balance sheet and the previous one. But here required to record the above assets and the liabilities of partner R without revaluation, and any differences is debited in cash or in form. It's just in accounting form, but not in cash. Record the assets and the liabilities of partner B without revaluation, and any difference should be settled in accounting form, but not in cash. Yes, draw up the balance sheet for the partnership as at June 30, 2019.